Good day, everyone. I'm David Paul. I'm the Managing Director of VectorVest in the UK. And at VectorVest, our number one priority is to show everyone how to go about making money in the London stock market. And we firmly believe that the most important thing to know is whether the market is rising or falling. Everything follows from that. So the first slide that I've got for you today is the London stock market itself. It's the VectorVest composite of the London stock market, and it's an equally weighted index of all of the shares that we follow on the LSE and on AIM, some 2,200 shares. Right at the top left-hand side of the chart, you should see a red triangle, and that was our sell signal on the 5th of October last year. And that told us that it wasn't a good time to be in the stock market in October, November, December. And those of you that were around at that period will know that it was now near impossible to make some money buying stocks in that period. All changed at Christmas, and somewhere between Christmas and New Year, market bottomed out, and we got our buy signal. That you should see that green triangle on the 9th of January, and that is still running towards the end of April. So the London market is rising. A very similar situation in the US market, but the US market firing a warning signal in that the breadth of the advance is narrowing in the US. It's narrowing in the UK as well, but not nearly as marked as in the US. So the US stock market's rising, but in a lower and lower participation or buy-sell ratio, the number of shares in a buy recommendation divided by the number of shares in a sell recommendation, which we refer to as the canary because it gives an early warning signal, is showing marked divergence with the price. So there is a little warning in the air in the American stock market. Now, I've got two shares for you today, two AIM shares. And the first share, which I've got on the next slide, is DART, and DART, an aviation company. And I've got that's a weekly chart over 3 years. And the green line in the same window as the price candles is the VectorVest valuation. And the blue line in the window below the price is forecast earnings per share. And over the last few months, forecast earnings per share has risen significantly, and on that basis, VectorVest has revalued the share, and the share is now significantly undervalued, and we favour undervalued shares. We favour shares that are growing earnings strongly and safely, and DART fits the bill. It's pulled back to a long-term trend line, so once I've established the fundamental position, then in the next slide we can look at the more detailed technical position. And as you can see, the price is pulled back to that long-term trend line. It's actually pulled back to an old high. And if I were to draw a Fibonacci retracement there, it's actually pulled back to a 62% retracement level. I didn't put the Fibonacci on because it clutters the chart. Very importantly, I've added a weekly MACD indicator, moving average converging diverging, which is a momentum indicator designed by a fellow called Gerald Appel some 20 or 30 years ago. And that's given a buy signal recently, but very importantly, the buy signal was preceded by a very strong divergence pattern known by market technicians as reverse divergence, and it invariably precedes quite a strong move. So in DART, one, the fundamental position of the share looks good, the technical position of the share looks good, and the London stock market is rising. So I've ticked all three boxes, and DART has got a high probability of moving higher. I don't know what's going to happen next, but nevertheless, the probabilities I think look good for DART. The second share is also an AIM share, and it's a share called FairFX. And FairFX, again undervalued, and you can see the green valuation above the price. You can see earnings per share rising in that window below the price. And it's pulled back to a previous old high. So again, the fundamental position looks good. If we go to the next slide, we can see, in fact, that it's pulled back to an old high. During the sell-off, it broke the long-term trend line, which was a worry for a while. It's sitting at a 78%, a very important fib retracement level. So we've got a confluence of that last old high plus the 78% retracement level. And again, I'm seeing a reverse divergence on the weekly MACD indicator. The MACD indicator is just given a buy signal preceded by that divergence. Last week, we had a very strong outside week, which ended up with the price in the top 20% of the price range of the week. And I believe that that bodes well for a move up the page in fair FX. In terms of the safety and the predictability of the earnings, we have a metric called relative safety, and DART fares much better in terms of relative safety than fair FX. In relative safety, we look at the balance sheet, the income statement, the cash flow statement, all the ratios, and we make a judgment as to whether the company is making money, and all those financial ratios are getting better. DART, based on the track record, is a safer proposition. But for the more adventurous trader, fair FX fundamentally and technically looks as if it can actually move up quite strongly. So those are two AIM shares that I think stand a high probability of moving northwards, assuming the general market can keep moving up. My only worry is the lack of breadth on the American market rising, and our canary, the buy-sell ratio, in fact falling and falling quite strongly. So that is a worry, saying that this run-up, we had 14 weeks down in October, November, December. We've now had 17 weeks up, and we're running into May. But the buy-sell ratio has got an exceptionally good history of a warning signal. That's why it's called the canary. Thank you very much.